right, welcome back everyone. This is now episode 4 of Equanimity, and man, am I excited for another investing video to share with you guys today. You know, the channel has been doing pretty well. I mean, ultimately we set out with the initial goal of trying to reach 100 subscribers and 1,000 views on one of these longer form videos, and I'm proud to say we are almost there. Right now at about 71 subscribers on YouTube with, I think we hit about 100 views on the last video. So definitely still some work in progress, but we're making slow and steady steps. And to think that this all just began less than a month ago on December 7th, I think I'm really pleased with the progress so far. And it really is a testament to all of you helping me out. And I can only really ever do it with you guys. So you know, as we keep doing this, if you can be sure to subscribe, like, comment, and pass this along, it means a lot. It really helps this thing grow and allows us to help build this community of investors that are looking at things differently than most. And that is really the goal. So, you know, with that, today's video is going to kind of take a pivot away from what we have done in the past. And it's still going to carry some of the elements, but really, one of the most important figures in all of investing retired this week, and that is Warren Buffett. You know, he really is arguably the greatest investor of all time. It is crazy to see his track record over a 60, 70-year period, and that's what it ultimately comes down to, is that level of sustainability. Decade after decade, Warren Buffett outperformed the market, and he continues to do it today. And now as he moves on to this next chapter in his life and the company shifts when it comes to their management team, this is going to be both an exciting but uncertain period for a lot of people. But one way or another, nobody has done as much as Warren Buffett. So I think, you know, because of his influence and impact and really what he's done for me as well, is I thought I would make an entire video on him. But before we do dive into that, you know, course of action, as we always do, we want to cover the top 10 stocks on my list as of the most recent period. And since our last video was 2 weeks ago, it is time for an update. So I have refreshed the free cash flow yield rankings. I have refreshed our over under based on our discounted cash flow as it is relative or measured against its market cap value, and readjusted those rankings. And from there, we have now built our fresh set of top 10. Now, one thing I want to highlight here is, as you can see, there's a color combination on the side here. And what this does is it allows me to track when the company's 10K is coming out. And for those who may not be familiar, a 10K is simply the company's annual financial statements and report. And so this provides the whole year picture of how the business performed in its last fiscal year. And what you'll see is that a lot of companies have dark blue. And for me, that is a Q4 measurement. So in other words, this is probably my favorite time of the year as an investor, because a lot of businesses are going to provide updated financial data. And this allows us to refine our models here, get more accurate and up-to-date information, and it will allow us to see how these rankings will swing, which they will. And, you know, no company is necessarily going to stay in the same position all the time, but this gives us our best look. And so, you know, stick around, because I'm thinking probably next video, maybe the one after that, we're going to have a huge update. I'm going to make sure that throughout the entire process, I will bring to your attention any companies that have been updated. We'll go through a quick analysis of them and then ultimately see where they stand amongst the other businesses that I track. With that said though, we are starting with our top 10 list, and this is to kick off the 2026 year. So the top 10 stocks for 2026 as of the first week of January are: number 1, Euroseas; number 2, Copart; number 3, Fortinet; number 4, Medifast; number 5, Regeneron Pharmaceuticals; number 6, Arista Networks; number 7, Houlihan Lokey; number 8, Nvidia; number 9, PDD Holdings; and number 10, Adobe. So a couple swings here and there, not a huge number of changes overall. Companies are still staying performing, and ultimately, again, this is value, so or value measurement at this time, so things aren't going to change too much. But as these financial statements come out and the data gets updated, I'm really curious to see where this changes and how things update going into 2026. So stick around for the upcoming videos. But with that addressed, with those covered, now the main topic of conversation for today. So, Warren Buffett. Many of you have probably heard of him as soon as you started investing or you're familiar with him from one way or another, but he truly is the greatest investor of all time. As you can see, his net worth has amassed to about $150 billion. And more than anything, I think a real testament to who he is that he has committed to donate 99% of his net worth over his lifetime and as he passes, and give that back to the charity, give that back to the community. And I think that is an important piece because what it highlights is where the benefits and strengths of capitalism really shine through. If you enable entrepreneurs to pursue their passions, to chase after risks and face new challenges, innovate, create, and be rewarded for it, you're ultimately going to produce a more productive economy, a more structured civilization, and that leads to, one, new innovations, new developments, new products, things that benefit you directly, and you can see it all around. But two, it allows people to have an opportunity to then give back when it's all said and done. And not every billionaire is going to pass on all their net worth, but even if you can make them give back a little bit, but as a result of allowing them to grow throughout their lifetime and really strive for what they are ultimately trying to achieve, I think it is a truly productive system. And Warren Buffett is a great example of that because not only has he been able to achieve such a fortune, but he's giving it back. And more importantly than anything, it really is his integrity. And I think that's what sticks with people the most. It's what resonates, is that he has always operated with a level of transparency that is very rare when it comes to CEOs, billionaires, and ultimately people of power. Every single year he has his annual shareholder meeting and thousands of people flock to Omaha, Nebraska to hear this man listen. And all he does is share his wisdom. My favorite thing about Warren Buffett is that he has been always willing to lay out his strategy, his philosophy without hesitation, and he has done so generously time and time again. Since the beginning, since he started having a platform and, news media stations started to take notice of him, he has continually reinforced his ideas of assessing value, trying to find undervalued stocks from that, and then purchasing quality further along the way. And it's written in stone. Like, the crazy part about it is that so few investors focus on this, and yet all the information is out there. This man has provided his entire blueprint for every single investor, and all you have to do is go and dig. And, here's a prime example. I love reading. This is just 7 of the books I've read, but 7 of, I think, very valuable pieces of information. They're not necessarily directly about Warren Buffett, but they are either a product of where he learned or where he or whom he taught. And so the first one is The Dando Investor by Monish Pabrai, a phenomenal investor. Good friends actually with Warren, and more so his late partner, Charlie Munger. Obviously, The Intelligent Investor, Benjamin Graham. Warren Buffett went to school and learned under Ben, and then ultimately worked for him for some time. So that is a direct descendant. Then we got The Education of a Value Investor. This is by Guy Spear, another phenomenal book, another phenomenal investor and person who shares a lot of wisdom. Close friends with Monish Pabrai, so 2 other really valuable resources that you can kind of listen to. William Green, phenomenal author and has studied a lot of investors, writes about Warren in this book, as well as Monish and many other investors that kind of follow a similar pursuit. One of my favorite books, The Outsiders, this kind of highlights how Warren Buffett acted differently along with other CEOs, allowing them to generate market-beating returns. We got Tap Dancing to Work, which is all about Warren Buffett and his life and his letters. And I think it is a really good book that just speaks to his history. And very similarly, The Warren Buffett Way by Robert Hagstrom. So 7 great books. There are so many out there on this guy. And I think it's just one of those things that the more you can learn and search out good information is another important part of it, is the quicker you're going to develop, but also while having a strong foundation. And so I cannot encourage it enough that you should go and learn about Warren Buffett. You should go watch his annual shareholder meetings. You should go read the annual letters online, and you should read as many books as you can, listen to podcasts, whatever you can do to expose yourself and learn from somebody who has proven they can do it and do it over decades. That is a person you should study. And that is somebody that has had a massive impact on my life. You know, I started knowing absolutely nothing about investing. When I went into university, I didn't know what a dividend was. I really didn't have a clear idea of what revenue or profits were. And it was because of his teachings and the influence he had on other investors that ultimately trickled down and found its way to me. And now it has made a profound impact on my life. And I'm just trying to do a small part in sharing the message that he ultimately taught and that many of the best investors do. And hopefully it provides some benefit to you. So now that I've kind of given that brief overview, let's actually see the numbers. Let's see how this man performed through his company, Berkshire Hathaway. I'll also do later an analysis. I've been tracking Berkshire for a long time, and so we can see how their financial performance has developed over the past 14 years or so. You know, they'll release their information. They typically do so in March, roughly April time period is when they release their 10K, so we'll have to wait a little longer for 2025 results. But we can see that just the level of consistency, the strength of the foundation that is Berkshire Hathaway, there are very few companies that are close to it, and you'll see that here. So first things first, this is directly from their most recent annual shareholder letter. You can just find this at berkshirehathaway.com. All the letters from, I think, all the way to 1974, and maybe even further back, I can't remember, but you can go and read them all. And every year, consistently, Warren has written a letter that is roughly 10 to 13 pages long, and it breaks down the businesses and the operations of Berkshire Hathaway, but it also has so many gems about investing, and it really will have a huge impact. There is few resources out there that come directly from somebody who truly did figure it out that are free and accessible like this, and that is the Berkshire Hathaway annual shareholders letter. So you need to check them out. That said, what we are looking at is ultimately what you are seeing here is the annual performance of Berkshire Hathaway versus the S&P. And on any given month or year, you can see that, you know, things swing a lot. One year, 1995, Berkshire was up 57%, the S&P was up 34%. Next year, Berkshire was up 6% versus 23% for the S&P. So things fluctuate all the time. You're not going to track it directly, but what you can see at the bottom here is that on a compounded annual gain, so this is essentially the return on an annual basis, what Warren Buffett has achieved through Berkshire Hathaway from 1965 to 2024, so that is 60 years, they have generated a 20% market or share price growth rate over that time on an annual basis, and that is compared to 10.4% for the S&P. So it is essentially double from a percentage point. Now, you might think, well, what does that truly mean? How can you put this into pictures and understand how much your investment would be worth? Well, if you invested $1,000 back in 1965 into Berkshire Hathaway, your return would be $60 million today. Now compare that to the S&P 500, where you would only have $452,000 over that time. That is the difference that a 10% difference in growth performance can do for you and your portfolio. Now, what I am trying to accomplish is to do this on my own. That's why I invest. That's why I'm trying to take my financial means into my own hands, and I hope that you do too. But it goes to show that, yeah, you're still going to benefit tremendously. On a $1,000 investment turning out to be $452,000 over 60 years is still decent. Like, you're still going to be pleased you've made money. But when you focus on quality and you try and find it at attractive prices, this is what the difference is. $60 million versus $452,000. That is why I believe in this strategy, and it's not just a product of Warren Buffett. Many of the best investors have embraced similar philosophies and have reinforced that it is possible. And as I just said, it is all laid out there. Warren Buffett has shared his entire strategy. You can find so much information online through books, anywhere. There is just so much that you should be soaking in. And if you really do want to make a difference in terms of your financial well-being, this is how you do it. Put in the work, go grind, study, learn, grow, and then invest and put it into practice and reap the rewards. That is what I'm trying to do. And in some ways it's kind of an experiment. I'm like, let's just do this thing and find out if it works. And, so far it seemed to done pretty well, and I think it will continue. I'm only 5 years into my investing journey. Warren has been doing this for 60 plus years. And so there's a lot to go, but I think it's one of those things that the earlier you get started, the quicker you embrace this, and the more you try and learn, the better off you will be. And there's just so much growth and development that I can personally speak to just by trying to understand investing, understand business and history, and so many different things that are all a product of what was initially taught by Warren. So as we've talked about, this is what your return is. Pretty insane. Now, just another glimpse of where it's really come from. And this is just from 1996. So again, Berkshire Hathaway has actually been operating well before 1965. Warren Buffett actually acquired it, and he said that it was his biggest investing mistake, actually, because what essentially happened was, he saw this undervalued business that was lacking productivity, but he figured he could probably purchase it below its book value. He could then liquidate its assets at a reasonable price, make a decent return, and get out. But the former CEO prior to Buffett was super stubborn and refused to kind of bend to his will. He was not going to give up his company, and he manipulated or put Warren Buffett in a difficult situation. And I'm trying to remember exactly what happened, but essentially he screwed over Buffett. Buffett got pissed, and he was like, all right, I'm going to go buy the full business now. This is no longer just about investment. I'm trying to make a statement. He ends up acquiring this struggling mill company and takes it over, and then ultimately turns it into the greatest investing machine of all time. And that is just what you were seeing here. This is only from 1996. The company had a $38 billion market cap, and it really has just grown tremendously over that time. Now, there are a couple interesting points that I do want to highlight. Obviously, this time right here, 1999, this is the dot-com bubble, and you can see that the company reached about $115 billion market cap, and that fell all the way down to 66 around that period there. So pretty much a 50% drop right there. Recovers, does all right decently over the next decade. Once again, we face another period of pandemonium. There's high euphoria, things are growing, reaches about $219 billion market cap, and falls all the way down to 121. So just in this small glimpse over a, let's say, 30-year period, there have been 2 times where Berkshire Hathaway has fallen by around 50%, even more than 50% at times. And why am I highlighting this? Because it happens to everyone. Warren Buffett is the greatest investor of all time, and even him and his portfolio have fallen by more than 50%. Now, you can imagine that a lot of people out there, when they see that they are down in the dumps, their stock portfolio is tanking, they've lost 50% of their value, and all they can see is darkness, is they decide to sell. They panic, They say, I better hold on to what money I have left. I made a mistake. It's time to move on. I won't do that again, but it's time to stop investing and sell. This is probably the worst decision you can make. If you decide to liquidate your entire portfolio or a huge chunk just because the market is crashing, you are going to get burned and you are going to be disappointed with your results. What you'll notice, and if I had the information directly, but what you'll notice is that during these periods, Warren was not selling a bunch. Instead, what he was doing was anticipating the euphoria in the market. He saw that things were kind of running astray, that the prices of stocks and assets were becoming overvalued. People were becoming too euphoric. They believed only good was in sight, that stocks were going to keep rising up. And what did he do? He sort of sits back and he builds up this huge cash pile and he waits, because what comes up must come down in the market. Over time, it is a cyclical process. There are periods of prosperity and growth, and there are also periods of depression and contraction. And if you can understand that and position yourself and not panic when they happen, but capitalize instead, you are going to generate returns that beat the market. And that is a direct product. The numbers don't lie. You see from that point in time, where Warren built up this huge cash pile and then started investing in undervalued businesses at this time, the thing has just been on a tear ever since. And, over a 15-year period, the company went from a market cap of $121 billion to roughly $1.7 trillion or $1.07 trillion today. So absolutely absurd a level of growth, especially in the past 15 years. And now it's one of those things that, again, he positioned himself well. He knew that during times of euphoria where everybody's super bullish and things are on a run, seems like stocks are all rising, it's time to dial back your expectations. It's time to kind of sit back and think, is this really sustainable? Can businesses keep these high valuations for so long? And he doesn't know the timing of it. Nobody knows when the market will crash, and people will tell you all the time that it may be happening. Even I had suspicions like 5 years ago that really we were due for a major correction. And it hasn't really happened to my expectations. But so it's not so much about timing, but it's about studying good businesses, studying high quality assets, understanding them. And then when there is a moment in time when it looks attractive in price, it is the time to pounce. It is time to, as Warren would say, is grab your bathtub and fill it with water, not just a thimble. Go head first and start buying undervalued, high quality businesses while everyone else is afraid. Because, again, just as what must come up or what goes up must come down, things go up again. And if they are high quality, they will go at a higher clip than things that do not. And that is what Warren Buffett does so great. And you're actually going to see that a bit here too. I'm going to see if I can get the right piece here. But as of the 30th of September 2025, they have roughly $382 billion in cash. So many have been pointing that, maybe we are in a bubble today. Maybe we are due for a crash. This is my general belief as it is. And look who is more than ready to start buying attractive assets at attractive prices when the time comes. Nobody, I repeat, nobody is better prepared for the next great market crash, the next great recession, the next turmoil, conflict where the market corrects significantly past 25%, 50%, 70%. No matter how far down it goes, Berkshire Hathaway is ready. They have $382 billion of cash that they will go and buy high quality businesses with. The thing is, we just don't know when that time may come. It could happen tomorrow. It could happen 6 months from now. It could happen 2 years from now. It could be another decade. You just don't know. So you don't want to just fully sit on the sidelines. Clearly, the company is still invested in many things. But if you can build up that cash and you have that flexibility as an investor, then you are going to be set. You can capitalize on these great crashes and set yourself up for the next decade and beyond. That is kind of the goal, and Warren Buffett is a prime example of that. Now, the flip side, or kind of an interesting piece of this, is that often during these times of euphoria, a lot of people start to discount Buffett's methods. They begin to say, oh, it's outdated. He was an investor for past generations. There's a new wave coming, and the time to hop on the trend is now. And I think a prime example of this is Cathie Wood and her ARK investments versus Warren Buffett. Because especially during the reign of 2020 to 2022, during the most recent major bubble, let's say, that occurred following the COVID-19 pandemic, Cathie Wood's investment portfolios were on an absolute tear. They just skyrocketed, and, she is kind of hailed as this innovator and embracer of technology, this forward-thinking, futuristic investor that can anticipate all the trends. And, for a time there, it certainly looked like she was right. But where I think Cathie went wrong, and what speaks to Warren Buffett's strategy, is that Cathie tends to disregard valuation or have egregious valuations. She anticipates that Tesla can hit $10 billion market cap, $10 trillion market cap in, however long. And she has said that about other high quality tech companies. But if you do not ground yourself in reality, you get burned because you overpay, and it leads, ultimately, all things return to what their intrinsic value is worth over time. And if you overpay, it is going to regress. It is not going to grow. And that is kind of what happened. Is after the euphoria started to slow down, people started to realize that maybe things were getting out of control, and they started to sell. And then the fire sale followed after that. Cathie's portfolios got absolutely crushed. And she, the thing just absolutely tanked. And while all this is happening, slow and steady, but still market-beating returns, Warren Buffett and Berkshire Hathaway beat the race. And as of 2025, there is a huge gap. Cathie Wood and ARK are only up around 15%, whereas Berkshire Hathaway in that same 5-year period is up 193%. So consistency, realistic valuations, an understanding of quality, and the like are all important pieces that I think are important to look at, and will provide a good glimpse and perspective into why you should focus on quality as well as value, and not just get caught up in the hype or think too far down the line based on what could be because of technologies today. At the end of the day, history and the history of a company will show you what it is capable of, and then you should base initially your investment decision based on that, and then also try and anticipate where it might go. But always ground yourself in what the business is fundamentally capable of and has demonstrated in the past, because that will guide your expectations and protect you from making bad investments. And Warren Buffett is the prime example of that, because time and time again, you read it in The Intelligent Investor. Jason Zweig writes commentary throughout all of it, and he highlights that during the dot-com bubble, people were saying the exact same thing. Warren Buffett is outdated. His strategy is old news. The guy doesn't know the times anymore. He's old. He's washed. All these different things. And what ends up happening is a lot of those people that were hailed during those times for their major tech investments, they got burned. They are no longer spoken of. Their legacy is a lot quieter than what Warren Buffett's is. And that is because all the guy does is stick to the fundamentals. He holds his principles dearly, invests with the same rigor that he always has, and adapts, learns, but always keeps his expectations realistic. And that is something that every investor should aspire to. There's so much to learn from him that way, and is truly why I'm such a big fan of him. Now, moving on, we have looked at performance. Now it's kind of time, I think, to look at what Buffett and company have invested in. So everybody has talked about his Apple investment, and Coca-Cola is one of his biggest stories, Bank of America. But I think it does provide a good glimpse. And, as I talked about, I think in episode 2, learning from people who have successfully invested and then also have to share their investments publicly because they are so rich or they manage so much money is a great advantage. You can learn what the best investors in the world pick, and then you can go from there and study those businesses. And it already puts you on the right path, because clearly, based on Buffett's guys and his team's guys, they have assessed that these are decent businesses and worth investing in. So it's always a good start. Now, you will not know why an investor like Buffett decided to invest. His thesis or ideas are often held within the company, but so you shouldn't take it you should take it with a grain of salt. You shouldn't just go invest in it just because Buffett or any investor has, but you should use it as that guiding force for then you to go do your own research and kind of figure out why maybe Warren Buffett thought this was an attractive investment. That's ultimately the goal. But you can see a lot of just high quality businesses that are worth taking note of. Obviously, Apple, American Express, Bank of America, Coca-Cola, Chevron, Moody's, Occidental, all major corporations, and they all fill up a decent size, especially Apple, American Express, Bank of America, Coca-Cola, and Chevron. Right there, that's about 38, 48, 60% of the portfolio right there. So that's a sizable amount in just a few companies. And again, that kind of speaks, you find your runners and your highest quality stocks, and once you pick them, you just let them go to work, and it continues to grow, and it is phenomenal. You can see that growth. The company still owns about $65 billion right now in Apple, which is phenomenal. But even the further down the list, you can see Alphabet's here, which is Google. You can see Amazon, MasterCard, Sirius, Visa. A lot of good businesses, and definitely you'll see further down the line, they make up a lot less of the portfolio overall, but they're still a decent chunk. And the crazy thing is that when at essentially a 0.0%, you can find investment stakes of $126 million right there in a company like Allegiant. That is absurd. That is just the size and extent of the total portfolio there. It is absolutely ridiculous, but that is what they are invested in. The total portfolio is made up of $315 billion, and that's only one side of the equation. As I talked about, the company also has about $382 billion in cash, which is ridiculous. And then they also own a bunch of subsidiaries. And this would be companies that they have a majority stake in. They are no longer publicly traded. And, this is the net income, the revenues that help generate and produce what Berkshire is today. So I'll just go through a couple of the names that I think are notable, things that people are probably aware of, and maybe a couple that you didn't know. Number one is Burlington Northern Santa Fe. So Warren with Berkshire acquired one of the major Class 1 railways and has done a phenomenal job with it. And it really has become a major engine of the business there. You're looking also at, we got here, of course, Geico, one of the most famous and notable stories and investments that Warren and even Benjamin Graham actually invested in at the time. But that has essentially become the staple of the business's insurance division and a major driver of the company's success. They invest in smaller insurance businesses as well, like Byberk and various others here, but I think it's one of those very interesting ones. We talk about, they have Dairy Queen here, another interesting one that is kind of just very low key. And when I first found out that Warren owned Dairy Queen, I was like, what the heck? Who would have thought? All these years I've been buying and never would have had any clue. But you just kind of learn about that. NetJets is an interesting one here, and you can just see that there's probably about roughly 20 or I should say closer to 50 companies on this list that they essentially own outright. These are businesses that they have purchased over many decades and now have become important pieces of the business that can continue to develop its sustainability and enable it to grow. And once again, talking about the annual shareholders letters, that is a good place where you can learn a lot more about these, but even here, there's a link to each of them. So if you really wanted to dive deep into Berkshire, you could go and essentially study every company that the business owns, or at least most of them anyways, and get this holistic picture that really gives you a good idea of how the operations, and even through this unique, diverse business, they have been able to continue to produce and be overproductive relative to most of the market. So a couple neat things there. I think that's a good glimpse anyways at seeing what Berkshire Hathaway is made of, what Warren Buffett has picked over time, and what has enabled it to grow at 19.9% annually over 60 years, while the S&P has produced just 10%. And as a quick reminder, that difference in growth has made a $1,000 investment in 1965 $60 million, whereas the same investment in the S&P 500 would be worth about $456,000. So it does not even come close. If you chose and bet on Warren Buffett, if you chose quality and value over chasing trends, or even just playing it safe and investing in the index or an ETF, these are the results that you can hopefully expect. There's a much better chance of it. There's no guarantee of anything, but if you embrace the strategy, this is what is possible. Now, Warren Buffett's gone. This is a big question mark looming over everyone's head. Can Berkshire Hathaway sustain this growth? Are things going to fall apart now that things are changing, the tide has turned, and a new management team has taken over? Well, the new man at the helm is Gregory Abel. And interesting enough, this I think is just one of the coolest things is Greg is originally born and raised in Edmonton, Alberta, and he went to the University of Alberta for his school and business degree. And that is actually where I went to school. So not that there is any impact or influence beyond that, but I think it's a very neat little bonus, tucked away. I don't know how many people around the world are aware of Edmonton, Alberta, but Greg's put in the community and the city on the map, and I think it's neat that we share the same alma mater. So something cool. Now, Greg was actually acquired. He has long operated Berkshire's energy sector. So as you can see, executive chairman of Berkshire Hathaway Energy there. He did a phenomenal job, proved that he could create a highly productive business. This ultimately earned the trust of Buffett, and over the years and even decades, he has proven that he can, he is the man for the job that can take over. Now, he's closely tied with Ajit Jain, who has been running the insurance element of the business, and together those two are really going to be at the top when it comes to calling the shots. Greg has been given full trust by Buffett, but I'm sure he'll certainly continue to benefit from Mr. Jain as well. And then they also have Todd and Ted, who are essentially the investment managers who have operated underneath Buffett for some time as well. So between the four of them, it's tough to replace Buffett, but they have all been with him for close to 20 years at least now, I believe, all of them, and more for some of them as well. And it's just a continuation. Ultimately, a business like this, and I think what Buffett has done is he has tried to establish a strong culture. And for many, the culture is going to be the foundation. It is going to be the bedrock that shapes how well you can perform and if you can sustain this development over the long time. Are people going to uphold the principles, the mission, the values of the business well into the future? Well, if you build a strong culture that people can buy into, then that is much more likely. So what actually is this culture? Well, I think first it's built on integrity. Warren has always been highly transparent, both of the successes, but also the mistakes that have happened. He has admitted when he has made errors in judgment and made poor investments, but he has also taken it a step further. And, there's a great story, and I can't remember exactly what happened, but I think it was the manager of one of the subsidiaries essentially behaved inappropriately and kind of put Berkshire in a tough situation, both from a regulatory standpoint, but also from a reputation standpoint. And so that's produced one of the greatest quotes, I think, of Warren Buffett's time, where he said, lose me money and I will be understanding, but lose reputation and I will be ruthless. And I think that's just a further reinforcement of that culture. There is ultimately the reputation of a business, of an individual, can be built over a lifetime, but it can also be taken away in an instant. And so you want to do everything in your power to maintain that respect, that trust from shareholders and customers, all stakeholders really, and then try and develop something that benefits all parties involved. And I think that's what Berkshire is all about. They've always tried to be fair to the managers and the companies that they've acquired. They want to ensure that they're incentivized properly, that they're compensated properly, but they can also operate on their own. That's also a very unique element is, a lot of, especially venture capitalists, are very, very hands-on. Once they build a stake, they start putting pressure on the business. They start challenging them and trying to push them in a certain direction. And to a certain extent, that is useful. It can be very valuable at times, but it also is, very hovering, micromanaging, and it can lead the business in the wrong direction as well. And so what I think is unique about Berkshire and the companies they acquire is Buffett has always, purchased them outright, often tried to retain the same manager or original owner of the business and founder and say, hey, we're going to pay you this salary, we're going to give you this compensation, but we want you to run it exactly as you have been and continue to have complete autonomy, go make the decisions, and we will reap the rewards and support you where you need. If you need additional cash to inject growth and we have opportunities to expand the business, strengthen its foundation and fundamentals, we are all for it. We got $380 billion in cash sitting around. So if you have opportunities to invest and develop the businesses that we own, we are absolutely going to back you and we are not going to get in your way. And I think that's what Buffett has done. The other part of this is that he's tried to find managers in these companies and in the businesses that he invests in that are very capable, very smart, people that he can learn from as well. And I think it builds this cohesive environment where you have a lot of brilliant people working together, passing on ideas, building this culture, and again, just further reinforcing that integrity and trying to build the reputation of Berkshire Hathaway, Warren Buffett, Greg Abel, all of them, very favorable with the investment community, but also I believe the business community at large, and that is because they put so much emphasis on trying to develop that strong culture along with the financial engines that they operate in. So, with that, talked about culture, talked about their new management, talked about kind of Buffett's process and how we got there. The last part is kind of my own analysis and what I've tracked over time. So like I said, financially, they have a couple more months until their 2025 data is fully out, but we can look at a good glimpse here and just see where they have been at over the past 13 years or so. And kind of tell where they are at this stage in their business development. So from a revenue standpoint, they had about $162 billion in 2012. 2017, this doubled to $40 billion, and as of 2024, they are now at $371 billion of revenue. An absolute insane number. You can see over a 9-year growth, that is about 6% there, so definitely decent, not growing at a huge clip, but again, this is $1 trillion business that has existed for 60 plus years, and so that is still pretty phenomenal given their size and level of maturity. They have been consistently profitable, and Warren has always been critical of GAAP accounting because the way they buy and sell stock and how the company is measured, there's a couple different factors. I don't want to say anything without knowing for sure, but he has been critical because it's not necessarily a direct reflection and things swing all the time. So You'll see that shortly here, but 2012, they had $15 billion in net income, $45 billion in 2017. 2022, this is what I was talking about. They went negative for 1 year, which, again, the business has been consistently profitable the whole time. So this is just a reporting thing more than anything. But as of 2024, $89 billion in profit. So ridiculous number. That produces a net profit margin of about 24%. And consistently here, you can find that they're definitely in the double digits. More recently, aside from 2022 as an outlier, they have had an average profit margin of about 19% over the past 5 years. Phenomenal there. The return on invested capital as well, also 11% there, 10.6%. So really good numbers there. Anytime you can find a company above 10% ROIC, that's a really good, strong start. It demonstrates that they've continue to make smart investments and are growing at a good clip, and you can have a lot of confidence there. Moving on to the next financial metric here, book value. 2012, they had $192 billion in book value. 2017, $352 billion. And as of 2024, they are at $652 billion. So this is essentially, again, after all their liabilities are paid for, covered on an annual basis, how much value do they have left in their assets? And right now they have $652 billion. I think because of the way Berkshire Hathaway operates in many ways, where they have this $350 billion investment portfolio in stocks, as well as many subsidiaries, is that for Berkshire, book value is probably the most important metric, because in many ways it kind of operates like an investment fund, but it's operational. It runs the businesses, or many of the businesses, and develops them internally, whereas a lot of investment funds just simply acquire a portion of the assets and they kind of F off and let them do their thing. But book value, I think, is probably the important metric. That's already a good foundation. You got $652 billion in shareholder equity that you have after all your liabilities. But this is also a crazy thing. The company has no debt. They have had zero debt throughout all these years, and they have also not paid a dividend. Two things that I think are very uncommon characteristics of a business, but Buffett has always tried to build the company as sustainable as it can be, and debt is your worst enemy when it comes to sustainability. It can be very useful and it's effective when managed in a conservative way, but if you let it run out or run away on you, that's where you get burned, especially if you're a business that is losing money year over year. It's almost inevitable that you're going to go bankrupt. Like there are very few instances where, if on an annual and recurring basis you have a negative net profit, that you are going to be able to survive if you have debt on top of that, because you still have to pay your interest and you have to pay your principal eventually. And if you can't do it, then the banks will come knocking. They're going to want assets or compensation, and you better have it or the whole business is going to be liquidated. And so even though Berkshire Hathaway, Warren Buffett have built themselves into a financial fortress, they are still not taking any such risk. They have continued to operate with zero debt, even when you have the greatest investor of all time who could probably use that extra money and go out and buy things. Who needs to? That's especially true when you also have $380 billion of cash that are sitting on the side. Why would you ever need debt? They have just built themselves into a fantastic position that few have ever come close to. Now, the last one, also a highly important metric that is tied to any company here, is free cash flow. And in 2012, they had $11 billion in free cash flow. 2017, this grew to $34 billion in free cash flow. And then as of 2024, they were actually back at $12 billion of free cash flow. So that has actually kind of shrunk, and you'll notice that over the long term, again, free cash flow is negative 3% as of the past year. So it's it's an interesting one. Probably a point of criticism that you could say, well, maybe they're not necessarily being as productive. They got to figure out how to grow their free cash flow, and that is definitely based on how I assess companies, is going to weigh heavily on their growth rate here, and that's why you're only seeing 1.6%. That's what I think their long-term growth rate is. simply based on, or largely based on, where this free cash flow is growing. You can notice that, book value is growing decently, net income, again, not necessarily a reliable metric, and that comes from directly Warren Buffett, but it's really that free cash flow that weighs down, especially. You can kind of see that here in the chart as well. That book value has just continued to grow phenomenal. Again, 650 billion is ridiculous. Revenue, it's also pretty solid, but this is a very, very mature company. And at the size and scale, it is also, it's going to be inevitable that growth is going to be more difficult, and you're going to see that here in the metrics. And this is arguably like on the latter half of the company. Now, it's not to say that Berkshire Hathaway can't continue growing, because they certainly can, and they will. And again, if a market crash happens and they can go invest and deploy $350 billion, you bet your ass that they are going to continue growing, because they are going to purchase high quality businesses that they have probably been watching and scouting for a very long time, and now they can get them at super attractive prices. That said, is the company going to turn into a $10 trillion business, or even, let's say, a $3 trillion, $5 trillion business in the next 10 years? I would say it's very, very difficult. Over the long run, it will absolutely continue to grow, and it very well may well. But again, you just reach a certain size, and it becomes, one, a lot more difficult to find investments worth your while. Again, if you invested in $1 billion company, purchased it outright, and it doubled to $2 billion at their size, it wouldn't even make a dent on their growth. It's just way too small. You have to go look in that 50 billion to 100 billion and even $1 trillion range to find investments and acquire companies that are going to be reflective of your own size. And so that's the major challenge that Buffett, well, now Greg Abel and team at Berkshire Hathaway face. But it's still just such a beast. They have demonstrated that they can grow every single year at 20% annually, essentially. And that is something that is so rare. And part of it is because of their fundamentals and what they've proven over time, but it's also that faith. There are so many people invested in the company who have just simply put their trust in Buffett and team, and that has given them a fantastic position where the stock fluctuates a lot less, and people continue to see Berkshire Hathaway very, very favorably, and that has proven out well. Now, from a valuation standpoint, we have projected our free cash flow into the future with that long-term growth rate. We then add in the terminal value with that slashed in half growth rate. We get our net present value of $188 billion, and the cash was last updated at $331 billion. But total value of the business, the intrinsic value of Berkshire Hathaway, based on my assessment, is about $519 billion. So, a phenomenal valuation. Certainly a very big company, one of the biggest and highest valuations of all. The thing is that Berkshire Hathaway right now has a $1.1 trillion market cap. So I'm essentially saying that it is about 2x what it is. It is trading for 2x to what it is worth. And so I would argue it's probably a bit overvalued. Now, the unique caveat is, again, you are investing in, well, maybe not necessarily the greatest investor of all time now, but the team and the legacy that he has built through Berkshire Hathaway. And so you can kind of bend and say, it's probably more justifiable than a lot of companies to overpay for it. Now, at this price, who knows? I would love to find it at a much more attractive price. I don't know if it's going to happen, but if it definitely does, if it reached that $519 billion market cap, you bet your ass I would be buying more. But it's just one of those things that you have to wait. Warren always talks about price to book value as a good measure for the company. Simply, again, that is why it is probably the most important metric. It is a measurement of essentially what the value of those assets are after all liabilities are paid for. And from a valuation standpoint, right now, it's about 170%. I think Buffett always said that a good time to buy was that if the price to book was about 125%. So it's still even a bit overvalued from that metric there. But again, this is Berkshire Hathaway. This is one of the greatest businesses of all time. And you're probably not going to go wrong. It's just, again, will they keep up? Who knows? Now, I did want to show you where they kind of fit on the total scheme of things, where I measure them. Now, a couple things to keep in mind. Their growth rate is slow. The return on invested capital is 10%. Their net profit margin was about 19% over 5-year periods. They have zero debt, phenomenal. So these are all factors that are going to contribute to where they stand as well as their valuation. And what you're going to notice is, surprisingly enough, they are further down the list than you would probably anticipate. And so you can see here that I don't have the exact metric, but let's say they're probably falling around 47th on this list. But what does that kind of highlight? Well, this is one of the greatest companies of all time. It has proven themselves. They have demonstrated time and again how effective they are. They have the greatest investor of all time, and yet they still fall this low on the list. So another way to look at this is that there are many, many good companies out there, and you have to go look for them. Companies that are even potentially better investments than Berkshire Hathaway at this time. Now, I'm not going to say that every company that goes above this list is better than Berkshire Hathaway, because there are just so many factors to it. And, it's not like my model is the magic formula, the perfect end all be all, but it definitely has given me enough of a position where I feel confident in the outcomes that can be generated from it, and enabled me to generate market beating returns on multiple occasions. And so I think that's why it is useful. And more than anything, what you are seeing here is that there are plenty of businesses and companies out there that you can go find that have even better fundamentals and evaluations at this time than Berkshire Hathaway. That is a pretty bold statement. I think it is something that, it's pretty crazy, especially given everything that Berkshire has done. But there's so many opportunities. Go find them. Go search. This is what investing is all about, is going and learning, being curious, trying to develop your skills and expose yourself to as much as you can, because it is a continual learning process, which I think brings me to the last point is, now, not all of these investors are a direct descendant of Warren Buffett's strategy, but I will highlight a few because, once again, what they essentially did is they embraced the philosophy of Warren Buffett and the idea of quality and value, and then they went and sought out and tried to learn and master this art and science of investing. And it really is just a matter of being curious. Like, really, if you listen to any of them, it is these investors' fascination with investing and the whole process and businesses that sticks out most. So a couple that I will highlight here. As I mentioned, Monish Prabhai, The Dando Investor, fantastic book, fantastic investor, very wise and somebody to learn from. So Lee Lu is actually who Charlie Munger ended up investing with, and he has an absolutely insane story. He escaped communist China back in the 80s, and then ultimately came to the US. I think he went to Harvard, and with his student loans, essentially turned it into $1 million while he was still there. Crazy, ridiculous story. Just go learn from him. Like, phenomenal person to learn from. Premwatsa Fairfax, so I actually tracked this company. He's a Canadian. He owns the insurance business and has done a fantastic job there. Joe Greenblatt, another huge fan. I didn't show any of his books, but I'm a big fan of his books, the little book that beats the market. And he had phenomenal performance with Gotham Asset Management, and continues to do so even today. Bill Ackman, many hail him as the next Warren Buffett. I wouldn't go so far as to say that, but he certainly is a very impressive investor and somebody that you can learn a lot from. And he's demonstrated it time and again. He's willing to make bold bets. He even owns Uber Technologies, which is a company that we have covered in past videos there, so worth checking as well. But you got Chris Davis, Chuck Aker, Charlie Munger, as we talked about, Howard Marks, one of my favorite. Again, just a lot of people. All of them kind of descend from this Benjamin Graham investment tree, and more specifically tied to Warren Buffett and that philosophy. And it's not to say that they didn't do it on their own, but there's just so much valuable information that you can learn from Warren that it's just worth diving into. Like, I have truly learned so much from this person and those descendants or apostles that come from him, and I think you can benefit too. So with that, we have covered a ton of things in this video. I think it was a very valuable and a bit of a pivot from where we were before. But, you know, Warren Buffett's legacy, even after he retires and, you know, unfortunately in the near future is at some point likely to pass away, I think his legacy will endure time and again. People can learn so much, and the beauty is that, you know, we live in a time where there is so much information available that you can just continue to learn about him and develop and see all that he was able to accomplish, and then hopefully extract what you can and use it in your own approach. So with that, I don't think Warren will ever hear this, but if you are, thank you so much. Thank you for everything that you've done. You've made a huge impact on my life, and I hope to carry a small portion forward as we progress with this channel and throughout the rest of my life. So with that, if you've gotten this far in the video, thank you. I appreciate you all. And if you can subscribe, like, comment, it really makes this or helps go the distance. So thank you and peace out.